Going.
No, they said I should.
Lots
No,
to
no, I
talk
didn't.
about
All I
with
said was
taxes.
whenever you're comfortable.
Lots
That's
of-
all. I
lots
didn't
of
want
tax
to
stuff.
Well,
the thought.
part of it also is that since I am kind of our temporary pseudo accountant for the time being, so
That's right.
I may not be an accountant, but I play one on TV. My dad, but seriously, I mean, actually, part of the reason I actually got into financial planning is my dad was an accountant, and I used to do a lot of accounting work for him when I was in college and through high school, and I learned a little bit about it. And what I found actually was some of the accounting work was kind of boring to me, but I always thought the tax part was very interesting because it was very dynamic, and you're working with people and sort of their situation. So I've always tried to incorporate that into the work that we do, because if you can help people save money in taxes, then that's more funds that are available for them to fund their goals. And we were actually chatting, I teach, I think I shared with you guys, I also teach at Rider and at NYU, and actually we were talking a little bit about cash flow planning and tax planning last night. And one of the things I was talking a little bit about was I encourage the students to watch the debate. Now we know there's a lot of political craziness and all this, and unfortunately some hysteria. So I want to talk about some of the proposals and impact of some of the policies as well as some of the things that are going on right now and could change. But let's start with right now and where we are this year. So first of all, as we're thinking about year end, there's a couple of deadlines you want to be mindful of. One is if you're considering setting up a qualified plan for your business, okay? As part of the Secure Act and the Secure Act 2.0, they did create a number of incentives for small businesses to do that, including some tax credits towards some of the costs of setting up those plans. Many of those plans, if you want to set that up for next year, you need to, actually for this year, you need to set that up by October 1st of this year, okay? So there are certain types of qualified plans or retirement investments that you can actually do until April of next year, such as if you're contributing to an IRA or a Roth IRA, you have to set up by this year, but you can actually make contributions for this year up until April 15th of next year. Same thing if you have plans as a business owner, like a SEP plan, you can actually contribute until next year as well. So it's something to think about as you're getting towards the later part of the year if you haven't made contributions to that, okay? Additionally, regarding those plans, there's usually a provision for if you're over age 50, you can put extra money into those plans. I don't want to get into all the specific numbers because it varies by the plan and the individual. But one of the proposals that came out of the Secure Act, and I was actually researching this yesterday, which is that if you have a qualified plan, such as a 401k plan, those sorts of plans, they had created a rule that was supposed to go into effect this year that any catch-up provision, which is that extra amount you're allowed to put in if you're 50 and over, would have to go into a Roth 401k, okay? The IRS has actually extended the deadline for that, which is now, that isn't scheduled to start until 2026. However, employers will be required to offer a Roth 401k option, okay, starting next year if they haven't already done so, okay? So those are some of the things that are happening right now, but I want to talk a little bit about also some of the changes that could potentially happen in the tax law and then some of the proposals. So in 2017, the Tax Cut and Jobs Act was passed, which among other things, it lowered the corporate tax rate. It also got rid of, for many of you Jerseyites in particular, it reduced the acronym SALT, right, which state and local taxes. And the idea was that if you were to itemize your deductions, meaning that instead of taking the standard deduction, if you itemized, you would be able to itemize the full value of your state income tax, property tax, and so on. That was limited to $10,000, which for most individuals, especially in New Jersey, just on your income, it very well may have covered most of it. And property tax, well, we all know what property taxes are in New Jersey, which is why I live in Pennsylvania. You wouldn't get the full benefit of that, okay? Additionally, they changed the marginal tax rates, where they lowered them somewhat. They increased the standard deduction with the idea that less people would itemize. One thing that wasn't talked about that a lot of people may not be aware of is they also got rid of the personal exemption. That was usually about $4,000 per person, and that could make a big difference, especially if you had a number of dependents in your household, because they didn't take that into account anymore. Okay, so that, in order for it to pass the budget rules, in order for it to get through the legislature, they had to do something that's known as a sunset. What that means is that it expires in 2025. So after that, it would either have to be renewed, or it would just completely go away, or amended in some sort. This isn't unique. This actually happened with the tax cuts in the Bush administration, and the Obama administration subsequently did adopt most of those to kind of keep the continuity. The Congress, the thing that they're best at doing is nothing, so there's certainly a good possibility that this could happen, okay? If that were to happen, then what that would mean is the corporate tax would actually stay the same, because that was a separate provision, and that is a permanent provision, but they also doubled the exemption for estate tax. That would go back to approximately half of what it is that's exempt from estate tax. The marginal rates would go back up. The state and local tax deductions would be restored. The larger standard deduction would go away, which means that maybe more people would itemize, and those exemptions would come back. One of the things that I try to explain to people as a financial planner is, regardless of what happens, I can work with people, you know, CPA if he joins or whatever, I'm sure to say the same thing. We work with what the laws that they have. Another thing that is in the current tax law was something called, which is qualified business income. Many of you may be familiar with this. The idea is that there's a lot of businesses, the income passes through to the business owners, such as partnerships, sole proprietorships, S corps, and because of that, they're taxed at the owner's rate. And often that may be higher than they might have paid at a corporate tax rate or otherwise. So the idea behind it, especially for real estate, was that this would lower their tax burden by lowering some of those costs, and you get a savings for the pass-through entity. It's kind of convoluted, but the idea is that was a way to help out business. At the end of the day, for a lot of people, it ended up being a wash. You paid a little less here, and paid a little bit more here. My taxes didn't really change very much, so like the marginal rate went down, but we lost the personal exemption. We used to itemize, so we lost some of that, but then I got some savings for self-employment income. So let's think about the election. It's a very hot climate, unfortunately, these days, so this isn't designed to be a political discussion. Everybody has their own views. As a financial planner, my goal is to kind of convey that information. So if Trump were to win the election, the likelihood is those tax cuts would be extended, okay, and they would continue. Obviously, unless they don't have the votes in Congress, but I think the likelihood is it would be evenly divided, and they'd be able to get it through to at least continue, okay? One of the things that came out yesterday, and unfortunately they're both kind of trying to give a lot of money away to get people to vote. And unfortunately, they're both kind of trying to give a lot of money away to get people to vote, so how realistic is it? Is he indicated a willingness to restore the state and local tax deduction limits to what they were previously, even if the law were to remain. So that's good news for people in this area, right, where that would be more of a factor, but it is something, it may be a lot better. But what else is being proposed? Yes?
I mean, both of these are like spewing out like they're trying to buy votes right at this point.
Yeah.
One saying we're not going to tax tips. Now we're not going to tax overtime. The other one, we're going to give you $25,000 to buy a new home. I mean, it's just, I'd rather have a lower interest rate than $25,000. I mean, personally, but.
Well, let's talk about that. You're right. Okay. First of all, I don't think the $25,000 to get a home, just to give you money, will be passed. But I could see where some compromise legislation, maybe keep part of that Tax and Jobs Act, that is, as opposed, my wife and I were talking about this, we both agreed, you know, and she's definitely, I'm further from the center than I am, which is that, but we both agreed, look, you don't just give people all this money, but maybe sort of like what the SBA does, maybe you give some sort of loan that's at a subsidized rate that you have criteria that makes it easier to qualify for, or something like that. I could see something like that happening. Same thing with the proposal that Harris has put forth for small business owners, where they were talking about $50,000. I think most of these, if they were to come through, it would be more likely to be some sort of loan, or maybe forgivable loan over a period of time, or something that's subsidized at a lower rate. Something they did like during COVID, where the SBA was giving a lot of self-employed individuals and businesses loans that were easier to qualify for, and they had very attractive interest rates and very long periods to pay them off. So I could see them doing something like that. Whether they're just going to give away free stuff, it sounds great, but it's not going to happen. And quite frankly, I don't even think the proposal about SALT, if the tax law under Trump were to continue, would happen, because that they would have to actually vote in to make those changes, and there may not be the votes for that if they want to keep the legislation and just amend it. The point that I'm trying to make, and I'll continue on some of these, is that there's a lot of noise and a lot of rhetoric. So the same thing I tell my students is that focus on what they're trying to do, at least from a professional standpoint. If you're concerned about some of the personal things, that's obviously important, but when we're talking about it as business owners, like I have to talk to my clients about some of the impacts of that. Like people are scared, oh, well, I heard that that if Harris were to get in, they're gonna tax what's known as unrealized gains. And what that would mean is that if you own an asset and it gains money, such as real estate or a stock or whatever, you would actually have to pay tax on it based on the value at the end of the year, because it made money. Well, there's a couple problems with that. First of all, it may have made money, but you didn't sell it, so how are you gonna actually pay the tax on the money that you made? Right? First of all. Second of all, as we've seen the past few years, okay, in 2021, when the market recovered from COVID, it was up like 27%. Well, 2022, it was down like 23%. 2023, it was up about 23%. Right now, year to date, it's probably about 15%. So if you pay tax on a gain and you don't sell it, and then you have it the next year and you have a big loss, so what, do you get the money back?
Right.
And then the following year? So it would be so unwieldy from an administrative standpoint, it's not realistic.
Couldn't happen.
But the thing is, one second, I just want to make this one point. The thing is that people are getting all concerned about it. It's actually very limited for individuals who have assets or holdings of $100 million and above, and that's not being communicated. It's not like, okay, you have a stock portfolio worth $200,000 and you made $20,000, so you have to pay tax on it. No, that's not how this is going to work. Yes, question.
I was gonna say, but isn't that concept true with real estate? Don't they look at the value of your house and raise your taxes even though you're not selling it?
No,
No?
no, that's called spot assessing, that's illegal.
Well, when someone's taxes go up, why do they go up?
It usually goes up because they may raise the tax rate.
For the entire community.
So it's not based upon the value of your house,
No.
Not your individual home.
the
It's
value
the,
of the community.
it's the amount of tax that they need. They calculate what's called a millage rate. Like your house is assessed at a certain amount. You have an assessment. It's not an appraisal, it's an assessment. And then there's the millage rate. So that's a percentage of that. So the town takes all the assessments, adds them up, figures out how much budget they need, and they adjust their millage rate so it affects everybody the same.
So it has nothing to do with.
Think of it like a sales tax, right? They raised the sales tax from 6% to 7%, and the item still costs the same, but they're getting a little more money because of the fact that they
raised it.
Kind of like what happened in the town that I used to live in, Bordentown. The whole town got reassessed. Everybody got their panties in a bunch. The town got reassessed.
Every 10 years, they
So
reassess them.
that, which was great, it got reassessed. And so all these people, they fought the assessment and had their assessment lowered. What did the town do? They just raised the tax rate because they weren't going to make the amount. So they just, instead of whatever 2 point whatever, they raised it to 2.5 and said, we're still getting our money,
I'm not worried.
which is kind of funny.
So getting back to what I was saying, so ultimately, as evenly divided as is, as much as both of them are talking about a lot of those major changes, it's not likely. The most likely outcome is this. If Harris wins, the tax law will probably, for the most part, be let to expire. They may have a compromise on a couple issues for business owners to kind of save face, but overall it's probably gonna expire. The other thing to be mindful of is the fact that regardless of who's gonna quote unquote cut taxes, we're in a situation where the budget deficit has been growing substantially. When they did the tax cuts in 2017, that added to the budget deficit, and COVID really added to the deficit. When you hear the rhetoric about all this money that went out, it's a little disingenuous because both administrations did it, and I give credit to both administrations for this because it wasn't about that they were trying to give away all this. Was a lot of it poorly executed? Yes, but the reality was they were trying to stave off a catastrophe with limited information at the time. It's kind of trying to fix your car while it's running, you know.
Right.
The idea was they didn't know how bad this was going to get, and they didn't want to risk a catastrophe like the Great Depression, right? So, and by and large, that was avoided, right? We actually did better than
But they created
most of the
inflation.
country. But they created inflation. When you talk about affordability of housing and interest rates, it's important to recognize that that is not set by the administration, that's set by the Federal Reserve. They're actually meeting today, so
Thank you.
they're supposed to meet, I think, at 10 o'clock today. And so they'll be announcing if they're going to make a change in rates. It's expected that they'll cut rates a quarter point. There's some potential for a rate reduction of up to a half a point. Mortgage rates have already started falling in anticipation of that. As a matter of fact, I was reading an article saying the average mortgage rate is now down to about 6.29, and it's the lowest it's been in almost 2 years as it started to fall in expectation of rates. So that could spur a little bit of demand in the real estate market. Due to that, more people may be willing to put their houses on. It's still higher than people are used to, but the idea is that these are things that will probably happen based on the election. So keep an eye out on that, be mindful of what they're saying, but also think about how realistic what they're saying is, right? And then even came up in the debate, oh, you'll never get that through Congress. And that's actually a valid point, right? So for both individuals, just like where Trump said, oh, we're gonna have the government pay for IVF. That's not gonna happen, okay? They may codify that into law, but they're not gonna mandate it be paid for. They'll be like, yes, we'll protect it, okay? Because there's a consensus on that, I think. But as far as paying for it, it's very expensive, and that's not gonna happen.
Right.
So I'll stop here because I want to be respectful of people's times. Questions?
I have gotten a couple calls recently from prospects I've worked with, which certainly helps me because it gives them a sense of urgency, but they're afraid that Trump is gonna repeal the investment tax credit on solar. Number one, I don't know if that's possible, and even if it is, when you do it, I don't know. I mean, there's a lot of talk, but it doesn't necessarily mean you want to do that.
Can any of them do anything with that stuff? It has to go through Congress and Senate first, doesn't
I
it?
don't know if you can do executive order or.
No, you can't do an executive order to change the tax code. What you can do, as Mark said, is you can propose legislation. Tax legislation is often very complicated, and it does have to go through Congress. The reason that the law is set to expire, for example, is that to get legislation through, you have to have 60 votes in the Senate, right, to avoid the filibuster. Well, there is a trick that you can use if the legislation has budgeting impact, which tax legislation does. It's called budget reconciliation. When that happens, you only need 51 votes through the Senate. The catch is you then have to make the numbers work through that window to show that it can pay for itself. And the way that they do that is they set this legislation to expire after a period of time, the sunset. So, which is why that tax law is set to expire. That's why
This
the
one's
Bush.
different.
Yes,
This-
but
yeah.
what I'm getting at, this won't expire, but what I'm saying is that they didn't have, that was the only way that they could do this legislation, right? So my point is, to change existing legislation, they would either have to do something like that again as part of new legislation. They're not gonna do just a standalone on one tax credit for one type of item, right? Because it's just too impractical. So it could be dealt with as part of a comprehensive tax package. So the likelihood, are they gonna die on that hill and fight it? Probably not. Now, I'm not familiar enough to know if that's part of the legislation that was passed in 2017 where it's scheduled to sunset, but I believe there was a credit prior to that, even if It
It
is?
was, it's 2032,
Yeah.
it goes down and then ends completely in 2035.
So, my answer to that would be that unless they pass new legislation, I wouldn't worry too much about it. Because in the new legislation, they could certainly modify it or change it, and certainly if their administration's in power, they may decide to back up on that. But I think, regardless of the rhetoric, the energy strategy, I think for both of them is gonna really be all of the above. And I think that's kind of where we are. I think it's recognized, look, we're not ready to just get rid of all the traditional source of energy, right? I mean,
No, no.
my wife and I talked about getting an electric car, but it's like, well, she has a long commute and we travel. It's like, I don't wanna deal with trying to find a place and this and that or whatever and modify the house right now. So if we were to do anything, you'd probably get a hybrid for now. At least that way, you can get gas, right? Other questions?
I got a moment.
I was gonna say more on a personal,
Good,
but,
good.
okay. So my girlfriend was asking about this because she's always saved individually type of thing, just in a savings account.
Okay.
But she's putting like $17,000 in this account for that rainy day. And I said, that was a bit high of a number. You could definitely put some stuff into other options, something with high interest, a higher interest, or like a Roth IRA type of level. For her, she still worries about the liquidity of that. Is there a better option in that world where if she went high interest but short term, maybe like a year or 2 year, as opposed to a Roth IRA, which kind of generally is a little longer? Any thoughts
Okay.
on that? Yeah, yeah.
There's two pieces of that.
Yeah, yeah,
There's
sorry.
The liquidity of the investment and then the Roth tax. So let's talk about the Roth first. One of the biggest advantages of a Roth IRA is that if you put the money in and you meet the qualifications, which is holding it for at least 5 years or age 59 and a half, it's tax-free. But because it's after tax, you can always, at any time, for any reason, pull out your basis, like your contributions. Put 5,000 in Roth, it's worth 7, let's say, right? You can take that 5,000 out 6 months later, anytime you want. Regular IRAs or other plans don't work that way. So she could have the advantage of putting money in a Roth and it grow tax-free in that regard, and still maintain the liquidity. As far as something that provides a better yield, that may be short-term, right now, cash and money markets are actually paying pretty well. They're close to 5%. But as rates go down, one of the drawbacks of that is the returns on that are going to go down. If she wants to lock in something that's safe like that, that's fixed, it may be a good time to consider buying a CD that's
In a row.
it could be in a Roth, or it could be outside of a Roth. If it's outside of a Roth, it's gonna be taxed as ordinary income, which is the highest tax rate as opposed to tax-free for a Roth or capital gains or dividends. So she should probably be mindful of that issue. The issue with a CD, of course, is, well, to get that locked-in rate, you're locking it in for a period of time. If you take the money out, you pay a penalty.
A Roth is the most powerful investment.
Yeah. That's what I had
Because in
recommended.
the end, you take it out, you're not paying taxes when you,
And you can get
When
to
you're
it
older.
when you want.
Yeah.
and if you can take it out, take something out, that's what she wants, is a rainy day fund. She can still take some
And
of
you
the
can,
principal out.
you can
Yeah.
take it out without penalty also for a first-time home purchase, up to $10,000. But as I said, if you have a fair amount in it, you can always take out your
Yeah.
bases. But if she has more specific questions, I'm happy to talk to her.
Yeah, yeah, yeah.
So,
Yeah.
But it ultimately depends what you're gonna do, yes.
Yeah, so I have a Roth IRA and a 401k. You think I should invest more in the Roth IRA than the 401k because my age?
Well, one of my favorite sayings is it depends. It sort of depends on your situation,
Okay.
right? And it depends on how the plan's set up, depends on what your income is, your cash flow. Ideally, if you're eligible, what I would tell people is to maximize both. You maximize the tax savings in the 401k from your current income, and you maximize the tax-free for the Roth IRA. Because the problem is that a lot of people don't have different types of investments when they retire as far as how they're taxed. So the idea is if you have tax-free, tax-deferred, and taxable investments, you can pick and choose when you retire and you start pulling the money out, depending on what the tax laws are then, or what your individual situation is that year, and kind of be strategic in how you put it out. Let's say, for example, real quick, you're retired, right? And you have money in all three. And that year, you had like a big business loss because you're still working in your business part-time, or you had a big medical expense. So you're basically not gonna pay any tax anyway. That would probably be the year you pull all the money out of the money that you're gonna need out of your taxable investment, because it's not gonna matter, right? Maybe there's another year where you made a lot of money, right? That's the year you probably pull it out of the Roth. Or maybe they raise income tax rates substantially. Well, that's the year you might pull it out of the Roth, or the taxable, maybe as a capital gains rate. So the idea that's different between what we do and what accountants do, we have to know all the laws too, but the accountant's looking at what's going on now, right? This year, last year, preparing, maybe giving you advice for next year. But our approach when we look at taxes is to look at what you're doing this year, next year, and 30 years from now, to try to do it as tax efficiently as possible to set the stage for the future, which is one of the reasons I work very closely with accountants to kind of be able to do that. Any other questions? Okay.
All right,